Hi, welcome back. I'm Matthew Taylor of Taylor Retirement Services. Today's video is a post-2020 election update. What changes might be affecting you personally, what changes might be affecting the business world, and what you can do about it to help protect and shield your personal finances. So let's get started. During the campaign trail and in the debates, I heard Mr. Biden speak about how he was going to repeal the Trump tax cuts, and he was going to repeal them because they only benefited the wealthy. Well, in today's video, we're going to talk about the true impact of a possible Trump tax cut repeal, how that will affect your portfolio, and what you can do about it to stay ahead of any possible changes so you can capitalize them and make them work to your benefit. Now, the first possible change would be the standard deduction. The standard deduction is an amount of money that you're allowed to earn completely tax-free before you owe any income tax. Now, the higher the standard deduction, the more totally tax-free money you're allowed to earn before any income tax kicks in. Currently, the standard deduction is set at $12,000 for an individual, $24,000 for a married couple. If the Trump tax cuts are repealed, those tax cuts will drop from $12,000 for an individual to $6,350 for an individual. For a married couple, it will go from $24,000 down to $12,700. Now, this has the effect of increasing the average person's taxes by about $900 per year or $1,800 per couple. The next possible tax cut repeal would be in regards to the income tax rates on individuals. Now, the Trump tax cuts across the board lowered income taxes by about 2 to 3%. If Mr. Biden repeals the Trump tax cuts, personal income tax rates will go up across the board by 2 to 3%. Folks who are currently in the 10 or 12% income tax bracket will see their new tax bracket be 15%. Folks who are currently in the 22% bracket will see their taxes go up to 25%. Folks who are in the 32% bracket would see their taxes go up a little bit to 33%, and folks who are in the 37% bracket would see it go up to 39.6%. So pretty much across the board, 2 to 3% tax increase. What that means is about $1,500 per person, or about $3,000 for your average married couple in terms of income tax increases. So what do you do about this? Well, there is a technique whereby you can lock in today's lower tax rates for the rest of your life on your investments. I'm speaking about a Roth conversion. A Roth conversion is when you change regular IRA money into Roth IRA money. You pay the taxes now at today's lower tax rates so that you don't have to pay the taxes later at the higher tax rates. If you'd like to learn more about Roth conversions, please follow one of the links below on Roth conversions. Another possible change on the personal front is capital gains tax. Currently, capital gains tax is either 10 or 20%, depending upon your income tax bracket. Now, capital gains tax is a tax that gets assessed on assets that you sell for more than what you paid for them. So if you bought it for this and you sold it for that, the difference is taxable, and that's the capital gains tax rate, and it's either 10 or 20% currently. If the Trump tax cuts are repealed, it will go to 20%, and if Biden is true to his word, it will actually go to 39.6% for those who are currently in the 20% capital gains tax bracket. So if you were at 10, it's going to 20. If you were at 20, it's going to 39.6. So a big jump there in capital gains tax. So what do you do about it? Well, realize your capital gains this year. Sell your stuff that you have a capital gain in now. Pay the tax this year at today's lower tax rates. Now, if this is an investment that you really like and you want to hold forever, you can always buy it back in 31 days. What that will have done, it will have reset the clock. It'll have reset your cost basis to the higher amount. So you've got those taxes out of the way now at the lower rate. Now, also something that made me think about is the repealing of tax cuts is possible impact on estate tax. Right now, the federal estate tax is not a problem for most individuals because it only kicks in once you've got over $23 million worth of stuff as a married couple. If you do have more than $23 million worth of stuff, then the tax rate is only 40%, which isn't real bad in the history of estate tax. But if there is a complete repealing of all of these Republican tax cuts, the estate tax would jump to 55% on everything over $600,000. Now that's going to affect a lot more folks. It's very easy to have a house worth more than $600,000 if you're living in a major metropolitan area like Baltimore or Philly or Pittsburgh or New York or any other major city around the country. Now this is just conjecture. I didn't hear him specifically speak to the estate tax, but it would be consistent with what we've heard to date. Now, what do you do if estate tax jumps up? Well, there's a couple of techniques. One technique is life insurance. Life insurance is a great way to shelter money for the next generation. And then also the use of irrevocable trusts. If you'd like to learn more about this, you can follow the link in the description below on our estate planning videos to learn more about that. Now let's talk a little bit about changes of taxes in the business world. There's different types of corporations out there, and I'm just going to talk now about C corporations. C corporations are large corporations. They're the ones that have publicly traded stock. Your 401k, your mutual funds, your IRAs, they're buying shares of C corporations. Under current tax law, C Corps owe 21% of their profits in income tax. Now, if Biden gets the Trump tax cuts repealed, that tax rate will jump to 35%. That might not sound like a big difference, but it actually is. Imagine a company that has $25 million in sales, $23 million in expenses, $2 million in profits. Now, after you take away the income tax, currently those companies would have $1,580,000 in net profits after tax. If the Trump tax cuts are repealed and those taxes go back up to 35%, the same corporation with the same $25 million in sales, $23 million in expenses, $2 million in profits would only have $1,300,000 in profits after tax. So it would drop from $1,580,000 to $1,300,000 in profits. That drop in profits is 22%. So it would be logical for the stock market to have a correction. Now, what's so correct about the market losing 22%? I don't know, but that's what the other financial folks call it, a correction. Well, that correction could occur very quickly. Now realize that the stock market does not behave analytically, it behaves emotionally. Usually it pre-acts, it acts well in advance of the actual thing happening. But sometimes the stock market's in a bit of a denial and it reacts after the fact or more slowly. Now the stock market is never really predictable. You can't predict what it's going to do tomorrow or certainly not next month or next year. But what I can tell you is while the Trump tax cuts were being debated and it looked like they were being passed, the stock market actually gained 22% during that time period. So if this tax is then repealed, logic would dictate that during this process, the stock market would then drop 22%. So if you're concerned about a 22% drop in the stock market, I would suggest you follow the link to one of our videos below that talks about different styles of investments, conservative, moderate, and aggressive. And I would really suggest that you look into the more conservative and more moderate sides of investments because they will not be hurt by a 22% drop in the stock market. So there you have it. What's going to happen in the future? We're not really sure, but we've been watching the debates, we've been listening to the speeches, we've been reading the press releases, so we can help you be ahead of the game on any possible changes to help you protect and shield your assets for retirement. We're here for you. Just reach out, send us an email, or pick up the phone and give us a call. We're happy to help.